Howdy, everybody. Welcome to Liberty Call for Tuesday, April 8th, 2025. Hope you're having a fantastical day out there on the interwebs. Beautiful day here in Colorado. It is almost 70 degrees. I got shorts on. Went into town to get some errands. Had to have some food. We were gone all last week, so there wasn't a whole lot in the fridge to make for dinner last night. So anyways, all right. As far as markets are sliding again as the U.S. prepares for a drop to drop 104% tariff hammer on Chinese imports at midnight. Stocks are down. Treasury yields are spiking and investors are scrambling. But it's not all bad news. Health insurers are popping, and Levi Strauss shrugs off chaos with a surprise earnings win. So before we unpack all the madness, and speaking of March Madness, Cougars blew it last night. I have no, it's just being a Houston sports fan. I said this on Facebook earlier today, is very trying. And if I was still a drinker, I would probably have a headache today. But baseball season's here, and the Astros will probably, do their best to give me an ulcer through the summer. So, anyways, but before we break it all down, if you could do me a favor, if you could give me some thumbs up, a like, share, subscribe, a follow, and press that notification bell. All righty, well, let's hop to the markets. Dow Jones down. It was up a good part of the day and just fell like a stone here at the end of the trading session. Down 0.84%, 320 points, closed at 37,645. The S&P 500 down 1.47%, 74 points, closed at 4787. NASDAQ down 2.15%, 335 points, closed at 15,265. The VIX up 11.32%, it's at 5230. That is quite high. Let's see here. Canada down 1.54, Brazil down 1.56, and Mexico flat down 0.03. In Europe, lots of green. I'm not sure why. In Germany, they were up 2.36. The UK 2.71. France 2.5. The Netherlands 2.82%. Spain 2.37. Italy 2.44. Switzerland 3.09, and Portugal 2.8%. Russian exchanges, both green. The MOEX up 0.46, RTSI up 1.31%. And the overnight markets, the Nikkei bounced back pretty big, up 6.03%. Australia up 2.27, New Zealand up 1.9. In China, the Shanghai up 1.58, Shenzhen Component up 0.64, China A50 up 2.09, DJ Shanghai up 1.46, Hang Seng up 1.51, and the Taiwan weighted when it closed on the 7th, down 9.7. All right. Oh, there we go. I guess the U.S. markets didn't get the memo that Asia and Eastern or Western Europe put out. So it's, most of the day. Here, let me bring up the chart. We can look at it here. Let's go to the hourly. Yeah. So here's the Dow. It was up most of the morning, about 3.5%. Then it started, sliding. Bounced off the opener at the open, and then went back up a little bit, and then right about 3:00 Eastern, just so it went up from what was it? What did I say? About 3.5-ish to as low as 2.25. That's a pretty wild swing there, and then obviously finished the day up, down about 0.8. So, anyways, yeah, it's crazy times we're in right now. People are panicking. I imagine most of the uptrend in the morning had to do with dip buyers. Buy the dip, buy the dip. You hear that a lot out there in, the markets and the economy. So, anyways, be careful. I've been telling everyone, watch the VIX. That kind of gives you a guideline as far as whether or not you want to dip your toe into things. Because it can, if you're doing this on your own, it can be very things can be quite volatile. So, pick a position, stick with it, make a game plan for, what happens, if things go this way, for example, if the Federal Reserve comes to the rescue with rate cuts, know that probably what I would expect to happen is that the equity markets would go back up, and then we probably would experience some more inflation after that. So, if the Fed has any, a spine, they will, rebuff Mr. Trump and the administration and say, sorry, we have inflation's a problem. We're not lowering rates. Too bad. And, we're going to get the inflation squashed, maybe get a little deflation to help out the consumer. So, all right, let's get into the market recap. S&P 500 gives up gains after strong start as tariff uncertainty continues. The S&P 500 saw early gains fade fast Tuesday as tariff drama continued to whipsaw investor sentiment after rallying on the heels of a false report suggesting the Trump administration might delay or pause tariffs. The market gave up most of its gains once reality hit. The tariffs are still on. President Trump doubled down on his hardline trade stance, reaffirming plans to slap an additional 50% on Chinese goods unless Beijing backs down from its latest 34% hike on U.S. imports by April 8th, which is today. Confusion reigned in the markets early in the day as conflicting reports circulated on when tariffs would take effect at noon or midnight, adding to the volatility. I quite honestly don't see why that matters. If you're trading the market, I mean, again, pick a position and make a guesstimate on where you think things are headed, and just go with that play. So let's see, where was I? Okay. Meanwhile, Wall Street's fear gauge, the VIX, stayed elevated at near COVID era highs, and trading volume hit its highest in 18 years. Despite the tough talk, Treasury Secretary Scott Bessent revealed that nearly 70 countries have reached out to the U.S. for possible negotiations, signaling the door isn't entirely quite shut. Even Tesla CEO Elon Musk reportedly made a personal appeal to Trump over the weekend. Healthcare and chip stocks offered a bright spot. Medicare Advantage rate hikes boosted names like Humana, United Health, and CVS. So that's awesome news. That the fact that Medicare is raising rates, which you and I, the taxpayer, fund, is helping out the healthcare companies. Good. Broadcom surged nearly 5% after announcing a $10 billion stock buyback, while Marvell jumped on news it's selling its automotive Ethernet division to Infineon for $2.5 billion. Tech giants like Nvidia, Tesla, and Apple gave back earlier gains, with traders still wary of further tariff fallout. Looking ahead, Thursday's consumer price index report could provide more direction, especially as speculation grows that a 5 to 10% market drop might force the Fed to intervene. Yeah, I think that's the hope. Need some chapstick. After being somewhere humid for a week, come back here to this dry environment. My skin and eyes are dry. For now, markets remain stuck in a storm of policy uncertainty and inflation anxiety. All right, so that's that. Next up, wrong button. There we go. From Zero Hedge, the Avalanche has really just started. Credit market cracks raise fears of bankruptcy wave. So again, my prior life as in the credit side of the financial services world, when delinquencies rise, that typically is a sign that the economy is having problems. Just over a week ago, early signs of stress in the credit markets were surfacing, and now things are escalating quickly. While stocks have staged a volatile rebound, corporate bonds are still under pressure, and the credit market remains uneasy. Boaz Weinstein, founder of Saba Capital Management and a seasoned crisis trader, I'm not sure what that is. I've been in the business for 19 years, never heard that term, sounded the alarm in a recent interview with Bloomberg. He warned that the ongoing credit sell-off, fueled by rising tensions from President Trump's aggressive new tariffs, could spark a wave of corporate bankruptcies faster than we've seen in previous crises. Quote, the avalanche has really just started, end quote, Weinstein said. He believes the bankruptcy rate could spike quickly, especially since the Federal Reserve is essentially hamstrung, unable to cut rates as easily due to persistent inflation concerns. Well, if they hadn't printed all that money all those years ago, we probably wouldn't be in this mess. Weinstein cautioned that this isn't a buy the dip moment. Instead, he suggested it might be a time for investors to sell the dip, a stark shift from the typical playbook of the past decade. This is really major, and that's in quotes. He added, highlighting how credit markets started from already expensive valuations, leaving more room to fall. His comments echo growing fears across Wall Street. JP Morgan recently raised the odds of global recession to 60%, and other analysts are now rethinking previously optimistic forecasts, with Trump demanding the Fed act and inflation still a top concern. Policymakers face a difficult balancing act. If credit markets continue to crack, the Fed may be forced to act sooner than planned, potentially cutting rates in a stagflationary environment, but with volatility rising and risk premiums widening. Weinstein's warning is clear. The genie is out of the bottle, and there may be no quick fix this time. Well, they've gone to the well too many times with money creation and bailouts over really in 2000. I wasn't in the side of the business in 2001, 2000 when the .com busted. So I really don't remember. But definitely 2009. I think they created a couple $1 trillion to smooth things over, and then they kept interest rates at zero the entire time Black Jesus was president. So that didn't help things, because when you artificially keep rates low, it just builds up inflation hidden in the system that when it pops, you're like bam. So all the inflation that we felt in the last couple of years, it's easy to point your finger at the stimulus from COVID in 2020 and 2021, because you can see on the money supply how it jumped so significantly. But the money supply was creeping up, all through Obama's term, and same thing with during Trump's first term from 16 to 20. It's why would you go back to that well again? We know what the consequences are, and it's just going to create more problems. So. All right, last article here, also from Zero Hedge. Peter Schiff, stagflation is here and the Fed is clueless. Well, I'm not going to argue with that. Also, in the show notes, this URL is linked. So if you want to click, go to it and listen to Peter's longer talk. He's a bit of a, he loves his gold. So sometimes he, sometimes can't see through his love of gold, because he hates Bitcoin. So, take it with a grain of salt, but he is, solid on his, his statistics and his view of the economy. So, all right, so let's dive in. In his latest episode of the Peter Schiff Show, Peter Schiff pulled no punches, taking aim at the Federal Reserve, President Trump's tariff agenda, and crypto enthusiasts. Schiff warns that the economy is sliding deeper into stagflation, and that the Fed's obliviousness to this reality could lead to devastating consequences. Again, all things I've been, screaming at clients for the last couple of years. Schiff begins by revisiting Fed Chair Jerome Powell's 2024 press conference, where Powell dismissed stagflation concerns as laughable. Quote, that comment, Schiff said, is going to age like some subprime is contained. Schiff contends that all economic data now clearly points to stagflation, slowing growth and persistent inflation, and criticizes the Fed for missing the signs. He then turned his fire on Trump's upcoming reciprocal tariffs, particularly a 25% tariff on foreign cars, arguing that these costs won't fall on foreign exporters, but on American consumers. Quote, it's going to eat, nobody's going to eat these tariffs but Americans, end quote, he warns, pointing to the inflationary impact of higher consumer prices at a time when wages aren't keeping up. Schiff further argues that this inflationary shock will eventually force the Fed into cutting rates despite rising prices, a move he believed would spell disaster for the U.S. dollar, but send gold soaring. So take that for what it's worth. Read between the lines, folks. Quote, this is gold's moment, Schiff asserts. Bitcoin, it's going down. Gold is the true safe haven, end quote. Those are his words, not mine. He also calls out mainstream Republican commentators for blindly backing Trump's policies, drawing parallels to the GOP cheerleading before the 2008 financial crisis. Schiff warns that partisan loyalty could again blind many to the serious economic risks ahead. Ultimately, Schiff's message is stark. The Fed's credibility is eroding, tariffs are stoking inflation, and investors clinging to digital fantasies may be caught off guard as gold reclaims its safe haven status in a world waking up to stagflation. Well, here would be my suggestion. Look at all the alternatives that are out there, gold, silver, other minerals, other commodities, Bitcoin, the other cryptos that are out there. Educate yourself on, how they react in inflationary environments and, stagflationary environments. Like, you can look back at the 70s, and look at the asset classes that, outperformed during that time, and, just make an educated guess as far as, how to, diversify into those others, into those safe havens, while your typical equity and bond markets are probably gonna be a bit volatile. So again, spread the wealth around. That's probably my best advice is stay as diversified as possible, and but also don't try to catch a falling knife. That's some good advice. All right, well, that's everything that I had to cover for today. If anyone needs anything from me, please go to wait for it. DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a call. I'd be happy to help. Hope everyone out there has a wonderful evening, and I'll talk to everyone again next time. Adios.